Target will be reporting earnings tomorrow, May 17, before market. So today, May 16, is the last day to trade earnings, and since it's 2:56 p.m., it's the last hour and to trade earnings. So in this video, we're going to go over the unusual options we detected today on Target, and then we're going to analyze them to find out what direction the unusual options are pointing us towards. And then 3, we're going to go over our Target earnings trade. So without further ado, let's get right to them. So for the options today, we're going to look at all of the 1,000 contracts that happened today. And so we'll start with the 1101 here. This was the 165 strike puts, expiring May 19. So when we look at the chain, May 19 expires in 3 days. And so this is definitely an earnings trade. You'll see here 165 strikes. You'll see here the volume and the open interest. And you'll notice that the open interest at 891 is less than the 1,000 contracts that we saw for the unusual options. So we know that these are opening orders. And what we believe is going on is that they had bought the 165 strike puts, and that created a bearish trade. So you'll see here, Target is currently at 158. And as it moves down on the x-axis in price, this will become profitable because this is above the zero profit on the y-axis. Anything above that is profitable, and below that is a loss. So one thing to note is also that since currently it's going for $985 per contract, they're actually already profitable by at least $100 because they did it when Target was at 160, and currently it's already at 158, so it has dropped already $2. So that's why they're already profitable. And they got it for $865 originally at 11:01 a.m. So next up is the 1,000 here. These are actually the same type of trade because they're the same strike prices. And you'll also see this 110.24 at the 18-second mark lines up with this one here, the 160 here. And then this 10.22 at the 53-second mark lines up with this one here. So these are all the same. So it's a total of 2,000 145 strike puts and 2,160 strike puts for the June 16 expiration. These are spreads together. That's why here on the condition on the column here, it says that. And so what is going on here is that they are selling the 160 strike puts and buying the 145 strike puts. And we'll take a look at that. And you'll see here the 160 strike puts are here, and the 145 strike puts are here. Now, the open interest here is actually all greater than the 2,000. So a word of caution is that they may be closing these orders. So it could be the opposite of the opening order. So, for example, the opening order would be selling a bull put spread. Let's take the previous trade off, and so this is what the bull put spread is. So it is a bullish trade, 158 going up, and you'll see that going up above that zero profit line. So as I mentioned, however, keep in mind it could be a closing trade because of the open interest being greater than the volume of 2,000. So because we have a bullish and a bearish trade, as we showed a little earlier here, bearish and bullish, we are doing something a little different. And this is what our trade is going to be. And you'll see we already have some positions already on it here. We sold the 145 instead of buying it to create that bull put spread. We sold that, and then we bought the 140 strike. And then, however, we also did something additional. We sold another call spread over here at the 170 strikes. Right here, that's our position here. And so you'll see here we sold the 170 strikes, and then we bought the 175 to create a spread with a width of 5 strikes. And so this is an iron condor. We are selling an iron condor. So when you analyze this trade, you'll see this is our trade here. So we have our break evens here at expiration over here all the way at 172, and our low end of the break even is at 142 over here. Since this is where all of our profit potential is, that is above the 0 line. So when we look at the charts of 142 and 172, we'll have to zoom out a little bit to see where 142 is. So 142 is actually all the way down here. So target can come down here, and we would still be profitable. So it can drop, and it can also rally to 172, which is over here, about right here, which is one of the resistance levels here. You'll see here back this was back in April when it had this resistance. So we created a nice range for it to go after earnings and still be profitable, as long as it's all within this range, and it doesn't rally too much or it doesn't drop too much past our break evens. We will be profitable. We like this trade because if we look at the Greeks, we also have a very negative Vega trade. And as you know, Vega, which is volatility, will decrease after earnings. And so having a negative Vega is very favorable to earnings trades, and so that is why we like this trade. Also has a positive theta, which is very good, so it does not decay through time, and we have a slightly slightly -2 bias, -2 delta. So that is our trade, leaning a little bit bearish, but as you can see, we can come up all the way to 172 and will still be a profitable trade. Okay, so that is our trade. Let us know what you think is going to happen to Target after earnings tomorrow morning in the comments below, and please smash that like button so we can continue to make videos and share that knowledge with everyone. Please smash that like button, and take care and have a great day, everybody.